So this year, what really whacked the market in the first couple of months was the precipitous drop in oil prices. And we made reference to that in our year-end comments, our year-end letter. We said that the market will be, what the market does in the first quarter will be a function of what oil prices do. And why is that? Because if we said if oil prices continue to go down, the positive impact on consumers will not be enough to outweigh the negative impact on manufacturing companies that do well servicing, well drilling, make the tubes, make the drilling muds, carry transportation. And so the manufacturing sector was in a recession, has been in a recession, whereas the consumer kind of was just starting to get the benefit of lower gasoline prices. It was a milder winter, so the lower heating oil prices haven't necessarily kicked in. And also where the consumer is also paying down a little bit of debt. A lot of cars were bought with high loans, and so some of that is being paid down. Retail sales are not great, even though people are saving money from lower energy prices. So, but eventually it'll start to kick in. If oil prices do stay low, it'll start to kick in. Coincidentally, the market hit bottom and started to rally when oil prices hit bottom and started to rally. Not a coincidence. It's what we suggested would happen. But what we have seen is so many stocks that had their own kind of mini bear markets in 2015, which made it such a difficult year to make money. They seem to have hit bottom and had a pretty good rally. We're having a very good first quarter that we feel very proud of. There were no major changes in the portfolio, a little minor. We don't turn over the portfolio very much, so no, the portfolio is almost as it was at year-end. Nothing material that comes to mind. Hard to find new ideas after a big bull market, so we've added to some. A lot of our stocks got beaten up in the last 6 months, and we added to them. Don't ask me why, but we're outperforming on a material basis. Why? We're not smarter. We're not dumb. We weren't dumb then. We're not smart now. I think we're good at picking companies that do the right thing for shareholders. My advice is you don't want to get scared out by the violent intraday or intra-week down moves, and you don't want to get overexcited and chase up markets after they've had the vigorous rallies that we've had. The best approach, in my opinion, in a market where earnings growth is hard to find, where revenue growth is hard to find, is, I believe, stick with a diversified portfolio, be patient. The market rewards those who stick with it. I mean, that's Warren Buffett says it. I agree. Don't bet against America. We're coming out of this. Okay, the recovery from the Great Recession is slow. We had thought it would be slow. The market had so much compression in it. That's why you had 5 years of great outperformance. Now we need earnings growth, and lower oil prices should translate to better margins for companies that use a lot of energy. We'll see that. Maybe that'll have an effect. I think the dollar got too strong and was affecting our ability to sell things overseas. That seems to be coming in a little bit. Dollar seems to be going down. That's a positive. So, I mean, there are reasons to feel good about the direction that things are going.